She was 61 years old. She had just saved over $1.2 million, and she walked in my office and she was genuinely confident. She'd run the online calculators, she'd read the article, and by every benchmark she could find, she was ahead of the average for her age. So she expected good news. But about 5 minutes into our conversation, something shifted. Not because she'd done anything wrong, because the numbers she'd seen online that she'd been tracking for years had almost nothing to do with whether she could actually retire comfortably or not. And she's not alone. I see this constantly. Thousands of families, they hit their average. Some go well above it, and they carry this, they're confident. They're on track until someone actually sits them down and shows them what the number doesn't tell you. So in today's video, I'm going to walk you through the most recent Vanguard and Federal Reserve average savings data at age 55, 60, and 65. We'll talk about why the averages can be genuinely misleading, why the rules of thumb you've probably heard, they aren't much better. And I'll walk you through the 3 questions I actually use with clients to figure out whether someone is truly ready to retire. Not when some online calculator says they're ready to retire, but when they're actually ready to retire. My name is Chris McClure, and I've been a financial advisor for 31 years. I put these videos together about once a week or so, and I'm hoping that they're honest information for high net worth families who have worked too hard to leave money on the table. Before we get into numbers, there's one thing we're sorting out. Because most of these studies, they report 2 figures. There's the average, and then there's the median. And they sound similar, but they tell very different stories. You see, the average is everyone's savings added up and divided by the number of people. The problem is that there's a small number of people with very large account balances that pull that number way up. You may have heard of an investor called Peter Thiel. He has accumulated something like $5 billion in a Roth IRA. And so when that kind of account is in the data set, you can see how it would skew the picture for everyone else. You're essentially being compared to a tech billionaire, which isn't correct. The median is the middle number. So half the people are above it and half the people are below it. And that makes a much more realistic picture of what most families have actually saved. So you want to keep that in mind when you read this stuff. You want to keep that in mind as we go through this, because the gap between the average and the median, considering that the average counts a tech billionaire, it actually matters quite a bit. And here's a simple way to think about it. So if 5 people go out to dinner together, 4 of them order $20 meals and 1 person orders a $400 bottle of wine, the average bill is what? $100 per person. But that doesn't really reflect what most people actually got, right? So that's the exact thought there. That's what happens in retirement savings data. Is that person that ordered the $400 bottle of wine, it skews everything up. And so it's relying on the average alone, and it can send it in the wrong direction. So let's start with the most recent Vanguard data from their How America Saves in 2025. It was one of the most comprehensive looks at retirement savings in the country, and it drew on nearly 5 million plan participants. For people between ages of 55 and 64, the average balance was $271,000. But the median, the true middle, is around $88,000. And for those 65 and older, the average climbs to almost $300,000, while the median is $95,000. So you can see the gap. In some cases, it's almost 3 to 1. So that's not a mistake in the data. That's what a small number of very large accounts does to the picture. Most people sit much lower than the average suggests. Now, the Federal Reserve runs a broader survey called the Survey of Consumer Finances that includes not just retirement accounts, but also IRAs, savings accounts, CDs. It's really a more complete picture of what families actually have. So the numbers are higher across the board, and it's really worth looking at. For ages 55 to 64, the average total savings is $537,000. And the median is $185,000. And ages 65 to 74, the average is $609,000 and the median is $200,000. And it's actually the same pattern in every bracket. The gap between the Vanguard numbers and the Federal Reserve numbers is pretty large too. That's simply because the Fed, it's counting a wider range of accounts. Now, neither one's wrong. They're just measuring different things. So it's worth knowing which one you're looking at. But regardless of which data set you reference, these figures tell you how you compare to other people your age. What they don't tell you is whether your plan actually works, and that's a completely different question. The averages ignore your lifestyle and what you actually spend each month. They don't account for your tax situation, which can vary enormously from one family to the next. They don't factor in healthcare costs, which for a couple retiring at age 65 can range from the modest to well over $300,000 across their lifetime, depending on their health. And they say nothing about the inflation quietly eroding your purchasing power over a 25 or 30-year retirement. So what you end up with are two opposite mistakes, and both of them are costly. Some families retire too early because they hit the average or crossed some milestone and assume they were safe, and then they run into real problems in their mid-70s when it's too late to make changes. And then there are families on the other side who keep working years longer than they needed to because they felt behind the average, when in reality, they had plenty to retire on given their actual expenses and their income sources. The averages don't know which situation you're in, and that's the problem. Now, alongside these averages, you'll run into rules of thumb. The most common one comes from Fidelity, and it says by the age of 55, you should have 7 times your salary saved. By the age of 60, you should have 8 times. And by 67, you should have 10 times. So if you earn 200,000, that means 1.6 million saved by 60. It's clean math and it's easy to remember. The problem is it doesn't know your lifestyle. Someone earning $200,000 in a mid-city in the Midwest lives a completely different financial life than someone earning $200,000 in San Francisco or New York City. It's the same salary, but it's a completely different number than they actually need in retirement. You see, the rule of thumb, it doesn't account for that. Then there's the 25 times rule, which is really just expressing another way, which is the 4% rule. It says you need 25 times what you plan to withdraw from your portfolio each year. So if you need $80,000 annually from your investments, you need about $2 million saved. On paper, that makes a lot of sense. It's reasonable, but it assumes you spend the same amount every single year, which no one actually does. What I see with families is that spending tends to be highest in the early years of retirement. When people are healthy, they're active, they're traveling, they're fixing up the house, they're doing fun things. They finally have time for all this stuff that they put off. Then it gradually levels off through the mid-years. And late in retirement, healthcare costs can spike again. So the 4% rule, it doesn't bend to fit that reality. And it can cause families to either leave a lot of money unspent in their best years, or they're miscalculating what they'll actually need later. The rules of thumb, they're a great starting point. That's really about all they are. And in a minute, I'm going to show you two families where the same data, the same information, told completely opposite stories. One was well below the average and could already retire, and one who was well above the average and had a 6-figure problem that no one had actually found. And let me show you the questions that I actually asked to uncover these issues. Question 1 is, what will you actually spend each month on retirement? Not 80% of your current income, but your real number. What are you going to spend on housing? What are you going to spend on food, travel, hobbies, insurance, healthcare, taxes? All those things add up to what you're actually going to spend in retirement. And you want to track it. You don't want to estimate it. I've been doing this long enough to know that families almost always think they can spend less than they actually do. And building a retirement on an underestimate is a very bad way to get started in retirement. And it gets people into real trouble. The second thing I need to know is, what's the guaranteed income sources that you're going to have? Are you going to get Social Security? Are you going to get pensions? Do you have rental income from houses or properties? Do you have annuities? And how are each of these sources actually taxed? Because the tax on rental income is very different than the tax on annuities, or the tax on a pension is different than the tax you would get from Social Security. And the gap between what you plan to spend and what your guaranteed income is the number your savings actually need to fill. So that gap between your Social Security, your pension, whatever guaranteed income sources you have, and the amount you're going to spend is the amount that you're going to have to pull out of savings to reach your goals. And the funny thing is, that's the only figure that really matters, and it's completely personal to your situation. It has nothing to do with a financial rule or a rule of thumb. It's all about you. And the third question, and this is the one most families have never been asked, is whether everyone involved in your financial life is actually looking at the same picture. You see, what I've found over 31 years is that families, they often have pretty good advisors. They might have an investment person, they might have a CPA, they might have an estate planning person, but those professionals, they're frequently not working together. They're working in silos. The investment person maybe is just optimizing the portfolio. The CPA is maybe just managing the taxes. And no one is looking at the entire situation, how the withdrawal strategy interacts with their tax situation, or whether the estate documents still reflect the current plan, or whether the investments are creating extra taxes than you need. And that gap, that coordination gap, is where I actually see families lose real money. And it's not from bad investments. It's not from missing the average. It's actually from the left hand not knowing what the right hand is doing. So let me give you two situations that show how differently this plays out in practice. The first is a woman named Carol. She's 63 years old. She's a retired teacher. I come from a family of teachers, so I love her. She has about $380,000 saved. And by Vanguard's benchmark, she's well below where she should have been. And she'd been carrying that anxiety, that fear of retiring for years. And she thought she'd have to work to 67 or 68. She even turned down an early retirement from her school district the year before I met her because the number in her account didn't match what the calculators told her she needed. But we went through the three questions. The picture looked completely different. Her pension covered most of her monthly expenses. Her house was paid off. Her Social Security, if we timed it right, would fill almost the entire remaining gap. Her portfolio only needed to cover about $800 a month or so in additional spending. And at $380,000, that math works perfectly for 30 years. She could have retired a year earlier. She actually cried in my office when we went through the numbers, and not because things were bad. She says, I've been working extra years for a problem that I didn't actually have. I can't wait to retire. And then there's Tom and Linda. They had just under 3 million or so. They were both in their early 60s and they were planning to retire in 2 years. And by every benchmark, they were fine. The 8 times rule, the 4% rule, they checked every box. But when we mapped out their situation and their actual spending, and we ran the tax projections on their planned withdrawals, and we also looked at the Social Security timing question, we found out that $340,000 in taxes that they didn't need to pay. It wasn't from anything exotic. It was just from coordinating the withdrawal sequence from their actual tax situation, which no one had actually done before. Their investment advisor was focused on their job. The CPA was doing their job, but the two of them had never been in the same conversation about the same plan at the same time. What Tom told me was when we were finished, we thought we'd done everything right. It turns out we just hadn't had everyone talking to each other. So we actually reduced a $340,000 tax bill, which allowed them to retire on time just by making sure that the investments were done correctly and the taxes were done correctly. Two completely different situations. One family was below the average, who was ready to retire, and one family was well above it, who had a, $300,000 gap that no one had found. And so the average, it doesn't tell either story, right? The number in your account is one piece of information. It doesn't tell you what you spend, what you'll owe in taxes, how your income sources layer together, or whether the professionals managing different parts of your financial life are actually coordinating around the same plan. Those are the things that actually tell you whether you're ready, not where you rank against the national average. And the rules of thumb, they give you a rough target, but neither one tells you whether your plan actually works for your life. Your spending, your tax situation, your income sources, and whether the people managing money are working together is what really matters. If you've actually saved and you've done that saving and you're still not certain the pieces are actually coordinated, that's worth a real conversation. And I've put a link below in the chat to schedule a complimentary call with our team or with me. And we'll look at your actual situation, not against an average, but against your life and what you actually need your money to do. I'd be happy to chat with you and just look at your situation to see if we can help. And if you found this useful, hit subscribe. I put these out about once every week or so. I hope you enjoyed it. I hope it was helpful, and I'll see you on the next one.